Okay, we're going to get started by looking at the S&P 500. Right now, you can see we're overbought, and we're at the bottom of the channel. So we're basically halfway between overbought and oversold. It looks like this is still the worst month of the year, seasonality-wise. So let me see, where are we here in the calendar? We're right here. We're at a day, it's called Triple Witching Day. We've been looking at this. This happens once every quarter. Simultaneous expiration of options. It doesn't mean as much as it used to because there's options expiring every day, but in the good old days, they only expired once a quarter. But right now, that would explain a lot of volatility. Right now, this is one of the worst seasonality-wise months of the year, and it seems like right now we're in the S&P. We're in the middle of the our channel, our well-defined channel going up, and so far our support levels have been holding, which is good. So let's look at. Okay, so the things we have to think about in our calendar for this month are we have a Fed meeting. No, it's end of quarter window dressing happening 2 weeks from now. That's usually an indication that the stock market would probably go up for those stocks that have performed well until this time. And we also have a Fed meeting happening at the end of September. So we had one of the biggest stories that's not really a story this week is the price of oil has been going up. And we've been saying all year long the price of oil is inflationary. So let's look at our oil. So right now oil is at $90 a barrel. That's up 3.5%. We've been saying oil is inflationary for every day this year. And whenever the price of oil goes up, there's a very good chance that affects inflation, and that could make the Fed raise rates or keep rates higher longer. And that's not good. So we had a combination this week of the interest rates going up 3%. The Treasury rates for 2-year and 10-year have been going up. Usually that our formula is Treasury rates go up, and that's not good for stocks. Stocks go down, and that worked out this way this week also. Okay, so we're still not. We're losing momentum. We don't have a whole lot of momentum. We gained just a little bit percentage-wise this week, but we want the S&P 500 above the 250-day moving averages. On a regular basis, like 60 or 70% above the 200-day moving average to really know we have momentum going forward. So we're losing momentum in the stock market. And we have seasonality that's not on our side. So that combines to bad stock market performance. Okay, so what else do we have here? Dollar is strengthening. That is bad for large companies that do business overseas. So the dollar is continuing to strengthen. And these are all things that are going against the stock market going up. Hi Matt, how you doing?
Pretty busy.
There's a lot of people on vacation today. I know they told me.
Yeah, there's with the BAMS issue this week, we've been just doing some scrambling, and I've got some day one type stuff this weekend. So I don't.
Oh man. All right, you have to jump off. I'm recording it, so it's not a big deal.
Okay, I might jump off.
Yeah, right. So anyways, I'm just going over the S&P. The S&P is basically in nowhere land right now. It's right in the middle of our channel, and we're kind of overbought. We're in the worst time of the year for stocks, so it's looking like we're gonna have a correction here, and At least right now, this is triple witching day, so it's pretty volatile. But we have probably another week to go before we are done selling. Perhaps at the last week, we have end quarter window dressing. October is traditionally, it's a scary month. It's some of the biggest declines in history have been in October, but in general, it's a positive month. So even though it has that aura of the worst crashes in history happened then, it's actually a good month seasonality-wise. And then towards December, November, January, we have a better performance in the stock market. But right now, there's a lot of people that are saying that stock market is climbing a wall of worry. We have interest rates being raised and kept high, and there are people that say that, well, how much higher can it go whenever the earnings aren't increasing along with the stock price? So a lot of this gain this year has been on multiple expansion, which means people pay more for the same thing, and people pay, so the stocks are getting richer. And right now we're hugging this is the 50-day moving average. So that's good. If we hold that and we stay within our channel, we could be okay in the stock market. But if we start breaking through some of these moving averages, such as the 100-day moving average and the 200-day moving average, then we can't use this stochastics in predicting what's going to happen next. So let's look at some of our notes for today's meeting. Okay, this is the worst month of the year seasonality-wise. Average of negative 0.7%. And so towards the end of the year is usually a little bit better. And let me see. Okay, so yeah, we do have high oil. The oil stocks are going up today. Let's look at some of what's going up today in the. Let's see what's happening in the price of oil. Okay, this is so oil is going up again today. So we expect the oil stocks, energy stocks, to go up. So we have a bifurcated market now. We have basically oil and energy stocks going up today, and let's look at the actual market movers. I don't see any combinations that, let me see, the ones that are doing the worst are the Adobe. They gave bad guidance. They had good earnings, but they had bad guidance. We have a lot of semiconductor stocks in here. AMD, Applied Materials. These are all stocks that ran up with the AI hype. And yesterday we had ARM Holdings IPO, and there was a lot of fizz in the market because of it's the first big IPO this year. And but ARM isn't profitable, so there could be a lot of money going from some of these other semiconductor stocks in the ARM. So a lot of times when you have an IPO, you have to make room in your portfolio for a new position, and that could be what's happening here. Could be some profit taking. There's all these stocks went up a lot this year, the semiconductor stocks, and if it goes up too much, then there's the smart traders get out at the top. So let's see what else is happening here. We got let's look at the NASDAQ. What's doing the worst these are all the semiconductor stocks and software cloud oriented stocks. A lot of these are super high PE ratios, and they are ones that ran up a lot this year. So I don't know, it's hard to say. At least we have the great thing about the stock market, it's pretty predictable right now. It's in a defined channel. We're going to keep our eye on this channel, though. Whenever it breaks through this channel on the lower part, then we have to use these moving average lines to tell us when the stock market is going to be have some support. Okay, let's look at some of our notes for today's meeting. We actually were in the process of going through some of our earnings charts. What these charts are, I'll finish those today. We went through a bunch of them so far. This is earnings estimates that are consolidated using, and it tells you what analyst thinks the earnings are going to be in forward years. And we like to look at that and divide the years between this year and this year, this year and this year. We just divide 11 by 12, 1106 by 1212, and that gives you what's known as the growth rate of the earnings. And our formula for this is, let me get our formula real quick. Okay, so we're trying to look for certain things in the stock to make it a good look good. One of them is the earnings are going up in a straight line, and and it has high free cash flow. Right now, this is an example of UNH, and whenever you divide these earnings estimates year by year, that gives you the actual growth rate if you divide it. And we like to have stocks that have a PEG ratio less than or equal to 1, or if it's greater than 1, we like to have a moat, and we like to have consistency, and we like to have a return on equity greater than 10. We like to have a competitive edge and a dividend if possible, and we like to have a highly transparent and predictable growth, and little or no debt. So what we're going to do is we're going to look at the earnings charts for some of the stocks we've been following. We left off on right now. This week, Alphabet happens to be in the news. Alphabet is being scrutinized for anti-competitive behavior, and there could be some kind of breakup or some kind of have to follow that could hurt their growth rate. So we're going to keep an eye on our growth rates for these companies as the news comes out. So some of the possibilities for Alphabet are if they break the company up and they make their search engine have to be separate from YouTube or whatever, then you have multiple companies, each with pretty high growth rates. It won't be as strong as one company doing it all, but it's not doom and gloom if they do some corrective action with the company. But we're going to keep an eye on this. Right now, Google is growing around 15%. They have a P of 28, so the PEG ratio is pretty high at 1.86. But they have very consistent, over time, 15% growth rate. But that could be affected by rules that are placed by government agencies. We left off on Starbucks last week. I'm going to go over Starbucks. Okay, Starbucks, we went over Starbucks last time. They're going around 15%, and their dividend, their PE is 33. So if you divide 33 by their growth rate, you know the PEG ratio is 2. So they're around 2 times overvalued right now. I guess in this environment, the good thing about Starbucks is that it's an affordable luxury. So even though you have higher inflation and you have a consumer that's pretty stretched, a lot of times they can still buy their coffee as an affordable luxury. So let me see. Let's look at Verizon. This is like going the opposite way we'd like to see a stock and the earnings estimates. Right now, the earnings aren't going up in a straight line; they're basically sideways. So this stock is not a growth stock. It pays like an 8% dividend. As you can see, if I divide the years, it's not growing at all. has around a 7 or 8% dividend. Total return is around 7%. The PE is around 7. So it's really hard. It's really hard to really understand. I mean, it's not a growth stock. It might lose its dividend. If its dividend is cut, then there'll be a lot of selling because people own it basically for the dividend, it seems. Let's look at Visa. I divided year by year, this year by this year, this year by this year. I found that it's grown around 13%. Its PE ratio is 31, so its PEG ratio is 2. And you can see that this is going up in a straight line, and it's pretty consistent because people use their credit cards in good times and in bad times. And if you have an inflationary environment, people buy less things, but they pay more for it. So it balances out for Visa. The theme that we have for Visa as our investment theme is that most of the transactions around the world are still cash-based, and they're expanding the number of people that are using credit cards. And that same theme is we can use for MasterCard and American Express, other types of credit card processing companies. Okay, waste management. Right now they're growing around 12% if you average out all the years. Their PE is 28, and the PEG ratio is 2, so they're around 2 times overvalued. So if they give a bad report, there's a very good chance that their stock will go down in half, or if there's some bad news on the stock. The moat that the waste management have, they're one of the largest. They have a duopoly with Republic Services in America for waste, and it's very hard to get permits for waste facilities, number one. And number two, they have a very consistent business model where in the good times, people use trash as much as they do in bad times. And right now we have a lot of economic stimulus activities that could help increase the amount of waste, such as projects for the government, for roads and highways. So, but it seems like this company will grow as the U.S. economy grows. And as there are more houses created and more garbage cans sitting out in front of the house, the amount of trash needs picked up goes up. So that's the theme for this company. And so it's a little expensive, but it does have a duopoly. They're raising their prices gradually over time. So Amgen, right now, this is a very anemic growth. I see here it's like 3%. So it has a dividend, but it's not very compelling stock right now. So 3% growth. The PE is 17. That's a PEG ratio of 5. So it's pretty expensive. Let me see. Let's look at CVS. CVS is very inconsistent growth. You can see if you divide the year by year, it's basically not growing much at all in the first couple years, and then it's supposed to grow 9 or 10% after that. With a PE of 28, that's still super expensive, like a PEG ratio of 5. With a bad earnings report, it's bad news for this stock. It could go down a lot. So I'm not interested in this one. But we're following just for fun. It has a dividend of 3.69%, which is pretty good. Problem with CVS, the business, the problem is that their business model is not very durable. There's they have a part of their business is they sell medicine as a middleman, and there are some companies that are finding out that they can do it without the middleman. Like California basically turned away from using their services, and they're using Mark Cuban's company instead. So it is it's a flaky business model, and you can see the estimates that are going out aren't very reliable. So it's an example of a company that's it's Warren Buffett wouldn't be interested in this because it's not very durable and it doesn't have a moat. Okay, that was a good exercise. Johnson & Johnson. You can see that it's not growing a whole lot. This is like they have very similar to the Amgen, 3% to 5% growth, not much at all. And they also have the added problem of having a talcum powder lawsuit, which could wipe them out, totally wipe them out. They're breaking up their company into different pieces like Kenvue, because if they're wiped out, at least they can spin out some companies and salvage part of their companies. But it doesn't seem like a great company that is protected from major problems. Okay, Walmart. This is one of the strongest stocks we're following. It's doing well as people trade down. Like there's a lot of retail stocks these days that are doing really bad, and Walmart happens to be a beneficiary of a lot of trade downs. So Target, it's like having an upscale department store. People are leaving there and going to Walmart. People are leaving Dollar General and Dollar Tree, and they're deciding to get everything at one store, perhaps. And so Walmart is actually excelling in this environment. And you can see their growth rate is around 9%, PE of 31, and their PEG ratio is around 3. Another good thing about Walmart is they're reducing their salary for their entry-level people. Well, that'll help their margins. So this is a good example of a dividend growth stock. And let me see. Tractor Supply. This stock is currently growing around 9% if you average everything out. And their PE is 21, so it's a little bit rich. It's 2 times what its PEG ratio is 2, so it's double the price it should be. But I guess it has a certain consistency, and that's why people pay a little bit more for it. Let's look at Berkshire Hathaway. You can see that this is one of the only stocks we're following that doesn't have a whole lot of earnings estimates going forward. Right now, it only goes out 1 year. So there's not a whole lot of confidence with analysts to understand this company. So I guess whenever you invest in Berkshire Hathaway, you have to have faith that you're putting your money with one of the best investors of the world in Warren Buffett and Charlie Munger. So whenever you're investing in this company, you have to basically understand that they're doing things in the best of the shareholders, and you got to trust them, it seems. Also, let me see, their business is very confusing because the business is made up of, I'd say, mostly individual companies that they bought, and this is one of the only companies that actually has a portfolio of really big companies in addition to a position of stocks, portfolio of stocks. So that makes it very confusing for analysts, and that's why you only see 1 year out. I'm waiting for a good stock market correction, and then whenever this is on sale, then that will be a time to buy it. But right now, it's making all-time highs every day, so it's very strong. MasterCard. This is one of my favorite stocks because it's continuously growing around 15%, and it is the same theme as Visa. Visa has and MasterCard, they have a duopoly in processing most of the credit card payments around the world, and and you can see this. It's one of the strongest uptrends. I mean, in earnings, it's very consistent, and it's going up in a straight line. And you can see predicted earnings are going up in a straight line, so that's really good. So right now it's growing around 15 or 16%. Its PE is 38, and its PEG ratio is 2. So it's 2 times. It's trading at PEG ratio of 2, which is double its growth rate. So in a really bad market, it could drop in half, and that would be the most it would go down, it seems. Okay, eBay. eBay is kind of very anemic growth. Look, it's not growing a whole lot, maybe 6% if you add them all up and divide. So its PE is 17, so its PEG ratio is 3. So its stock is not growing, number one. And number two, it's not very exciting. There's no catalyst for the stock to go up. I guess the only catalyst I can see could be they're using their own payment system instead of PayPal now, so maybe they might earn a little bit more per transaction if you do that. And I guess if you go into a recession, people might have to sell some things to make some money for. I don't know. They still have a monopoly in auctions, and I think maybe a couple more years they have a patent for that, and so they still have a little bit of a moat with, selling things online, individual things from your house. But it doesn't seem very compelling, and it's still selling at a really big premium. So this one very well could be one that could correct in a bad market. Okay, Boeing. Let's look at this. For a large company, I've never seen, a company that has so much red in the earnings charts. It's pretty inconsistent. The company has some quality control issues. They have a duopoly in making large passenger jets in the world. They have one competitor in Europe, but right now they can sell as many airplanes as they can make. However, the quality isn't there, and they might have to redo some things. Like almost every month, there's another story that says, "Oh, they need to redo another part from one of their planes that they made." So I don't know. It's not a very consistent company, and you have negative 317% growth and 157, 43, 60. I don't know. There's a lot of inconsistent. I don't think Warren Buffett will be interested. It's because of that. It's pretty inconsistent business. Let me see the video. You can see that's growing around 35% for the next couple of years, but then it tails off to 13%. So it's trading. It's hard to say, but there's a lot of websites that say it's trading at 111 times earnings this year, but next year forward PE is like 28. But we don't know. The numbers aren't really presenting themselves to us very well. So they change all the time, so it's really hard to know what it's worth. Okay, Nike. You can see that they're growing around 14% on average. So the PE is 28 and the PEG ratio is 2. Right now, a lot of retail companies are having problems, and Nike's right in the middle of that. So they're trying to convert to a direct-to-consumer model, but as they're doing that, there's a slowdown in the economy, and there's a slowdown with customer transactions. So I don't know. This is kind of a sketchy one for right now. Ford is not growing at all. It's very inconsistent. There's some news. We'll go over some news articles about Ford. It's becoming a very unreliable and unpredictable stock, and I'm sure Warren Buffett wouldn't be interested in buying this one. One of the biggest problems with Ford is their labor is at the mercy of the United Auto Workers and demanding whatever they want. And if they can't get a good deal with the United Auto Workers, they're not going to be profitable. In addition to having competition from Tesla and all these other companies, they have an unknown amount of labor costs from from the union. So we have question marks everywhere in this company. So we knew it was bad before with these earnings estimates going down over time. or if sideways. But the only good thing about this company is it's paying a dividend, and they might have to reduce that if they don't have their earnings go up. All right. That was great to go over those earnings. We haven't done that ever before. So let's look at next thing. Let's look at some of our meeting notes. Okay. So we have triple witching today, expiration of options, and we have, let me see. Okay, some of our major parts of the market is oil is going up. So it seems like the oil and energy is the new momentum trade. And so we're going to follow the XLE chart. Let's look at the stochastics for the XLE. Here it is. You can see we're an established uptrend for the XLE, maybe a little bit more, and we're at the top of this channel. But we're overbought, and but it seems like this is our new momentum indicator as the S&P might be falling out this week. This week from our channel. Okay, so let's look at okay. So oil and energy is a new is in a new uptrend, and we also have dividend-related stocks showing some interest in the stock market. Like utilities went up a lot this week. All right, so fear greed. We're getting less fearful. Believe it or not, I would think we'd be getting fearful this week, but we're actually getting less fearful towards the greedy. And whenever we get to extreme greed, you have to start being fearful yourself and sell or don't buy. And okay, U.S. dollar index, we're still in an uptrend. So we're going up with the dollar. That's bad for U.S. companies, for the majority of U.S. companies. And so it's up 1% from last week. The VIX, this is surprising. We're super complacent. We're actually the lowest we've been all year long in the VIX. So people aren't really afraid. They're getting less fearful. They're becoming complacent. And that's right. That's surprising when we're in one of the worst times of the year for stock market, seasonality-wise. So I say, as of yesterday, we were in. This is our emotional chart. It seems like we were in our new paradigm. People are excited, delusional. There's an ARM IPO. It went up 20% in a day. It's feel good times. We have all the AI stocks going up. And that's exactly the time, when there's no fear, and this is usually corresponding with a VIX that's low. That's whenever, people are trying to buy this new IPO, and that's whenever everything goes down. So let's look at some of our reasons the stock market could go down. Major reasons, things that a lot of times stock markets crash because of debt issues, whether it's the United States debt, a company getting too leveraged and explodes. But right now we have some commercial real estate problems in America. We have consumer debt at an all-time high. People are not going to be able to buy more things on their credit cards. They're maxing out their credit cards. Then there's defaults. There's 30-day, 90-day defaults on credit cards, and that's going up. So that would affect the economy. People won't spend as much. If there's some AI stocks, they're starting to go down today. We saw that. So maybe that bubble is being pricked, and the higher treasury rates, that could make the stock market go down. So let's see if any of this comes true. We're just predicting it, but we don't want to be scared out of the market if it does happen, because a lot of times the stocks that we're following, for the most part, are insulated from needing to borrow money. So this is kind of irrelevant for the business models for stocks we're following. All right, here's some news articles. Tesla stock rises on an upgrade. Hope for Dojo supercomputer. I find it very fascinating that this analyst, Adam Jonas, said he raises his price target, doubling his price target. It's basically doubling the value of the company due to Tesla's supercomputer. I didn't even know about this. And how many other things is Tesla making that could be doubling the value of the company? That's very exciting for me as an investor. You know, we a couple weeks ago we were saying the supercharging network could make them into an ExxonMobil of the EV world, and now they have this supercomputer. So it seems like this Tesla is very creative. It could be the next really big growth company that keep making new products and doubling the value of their company by making new products. So they're saying that this supercomputer is going to help the Musk's companies to excel over their competitors. For instance, they'll use the supercomputer to train their models for making self-driving taxis or something like that. So I think it's getting more exciting every day, and I'm following this stock closely to see if earnings estimates change, but they're not really. Here's another article that says J.P. Morgan says the S&P is overvalued. And we've been saying this for a while, that the S&P basically is not growing. It's kind of the earnings multiple, people are paying more for it, and it's getting more expensive, and the stock prices are going up, but the actual earnings are not going up with them. So that's kind of a hint that a lot of times there's a return to the mean. So there's a very good chance that we'll go down to a S&P with a PE of 16. We're much higher than that now. So JP Morgan says that we're around 3 or 4 times overvalued. That's pretty big for a big company to say that. So you have to, you can't be, in other words, you can't be overextended in this environment. You got to assume that if you're buying in that there's going to be some time where you have to digest the earnings and let these stocks grow into their multiples. And so that's like sideways action. You have to be ready for that. Here's a news article. We've been following Ford, and we like a month ago we were looking at the earnings rates, or earnings projections for the company, and they were flat. They were like sideways. And at that time we were saying, well, at least it's good for a dividend. Now we have one of the largest costs of the company, labor, is going to be an unknown. And we have the Ford CEO saying no way we would be sustainable as a company with UAW's wage proposal. So it's looking like the UAW and the union is making these 3 big car companies to an unknown and unstable business model. But the one company that benefits from this is Tesla, because they don't use the UAW to make their cars. So so not only does Ford have a problem with growth and competition, they have a problem with an unknown. And if you have strikes with the company, then you can't produce a car. You don't have something to sell, and then you have to borrow money to stay alive. Oh wow, that's a bad problem. So I'm so not interested in these Ford, GM, or Chrysler because of that now. But we're going to follow it just to see how Tesla wins from all this. Most likely there's going to be a resolution, and they're going to be less profitable. Maybe they'll lose. We'll follow their earnings projections after this strike talk is complete. But right now, I looked at GM earnings estimates, and they're scheduled to basically flat for the next couple of years. -2, -10, 3, and 13%. So that's pretty inconsistent. That doesn't seem like a very profitable company. I don't think it's a good company. It's like not a good investment. Its PE is 4.7. Traditionally, car companies have traded at a very low PE because they don't grow very fast. Because you have a lot of labor and there's a lot that goes into making a car. And right now, it's capital intensive, it's called. So what probably is going to happen is the big three are going to go overseas to make their cars, and that's not going to look good for the president. And then the president will probably end up giving them some subsidies or something to stay in America. But I don't know. I don't want to be involved with that. It seems like the GM is look. The earnings are projected to go down or flat going out a couple of years. So that's not very good. Ford, the same thing. It's basically flat, no growth for the next couple of years. So our original thesis was, maybe Ford has the best-selling truck in America, and those owners would transition to driving EV vehicles, and that would be the best-selling EV vehicle in America. But they're not executing on that, and they're not making their cars efficiently, and they're being undercut by Tesla in price. So that makes them not profitable. It just, I'm going to avoid this sector altogether, except for Tesla. Okay, so Tesla is actually scheduled to grow around 25% a year for the next couple of years. So their P is 78. They're 3 times overvalued. But this is the only company I can think of that can come up with a new product or a new product line and double the value of the company overnight. And that's pretty exciting for an investor, and you have all of your competitors have these issues with the labor unions and trying to build batteries at the same cost as Tesla. I don't know. Seems like Tesla has one more good thing about it this week. All right. So I looked at Yahoo Finance right after that strike was announced last night, and everything was saying Tesla is the beneficiary of this. So Elon Musk is poised to benefit, and so it seems like Tesla's earnings estimates are going to go up because they're going to be selling cars when everyone else is on strike. Okay, let's look at I thought it'd be good to check in with T-Mobile. We've been following this for a while. Right now, it's been like going sideways for a year. I thought it'd be interesting because we've been following Apple, a lot of these phone companies, and they trade hand in hand. T-Mobile is actually growing around 25% a year. They just came out with a dividend 2 weeks ago. So their total return is around 27%. If you add their growth rate at 25 with their dividend, they proposed a 1.78% dividend. So they're about fairly valued now because their PE is around 27. And so they're a dividend growth company because they pay a dividend and they're growing. So let me see. Okay. So let's look at what some of the analysts are saying. Morningstar says their fair value is higher than what they're trading at. So they're 20%, 17% undervalued. So one thing, this is what that Morningstar, yeah. So this is CFRA's report. They say that they're undervalued by 17%. The same exact number as that. So it looks like the T-Mobile is doing much better than the other phone companies. I like to see the revenue go up year after year, like Tesla is. I mean Tesla, like T-Mobile. It's going. It's increasing every year. So that's a sign of a really good growth company, and their PE ratio is getting lower. You can see its PE ratio is lower than it was 5-10 years ago. So that's a good sign too. And one thing to keep in mind is the telecom companies work hand in hand with Apple, and their business models are intertwined. So one thing about Apple is it's really expensive, but they're getting a lot of business from the phone companies. The phone companies have to give away the latest phone to get customers to sign these contracts. So they're all they work together, and right now Apple is a beneficiary of that fight. But this one guy said Apple's stock valuation is unreasonable. We've been saying it's three or four times overvalued for a while now. So they say it's a shrinking company. Bill Miller is a value investor, so he knows a lot about valuing companies. But right now, what I thought would be good to go over Apple's earnings and see what they're really worth. If you look at Apple's chart, it was in an uptrend this year. And we said today that it broke that uptrend. That's too bad, because then now we're kind of making a new lower high, lower low in Apple, and that most likely will lead to this following this channel here, these lower highs, lower lows. But we're oversold with Apple right now, so that's a good sign. And we might be going into a sideways pattern. I'm not sure right after September, but we got to follow these trend lines. Okay, so right now the only levels of support for Apple are these moving averages, and as soon as they break these moving averages for support, if it breaks the 200-day moving average, then look out below. Okay, so Apple's earnings, it's grown around 9% if you average out all the years, and it has 0.78% dividend, so 0.5% dividend. So its total return is 9.5%. So it's 3 times overvalued, because the PE is 30 right now. So let me see. Let's look at some of Apple's statistics. Their forward PE is 26. Their PEG ratio is Yahoo's calculation is very similar to ours. It's 2.24. Their profit margin is great at 24, and their return on equity is better than most companies at 160. And they actually have more debt than they do cash right now. So if you see that they have $40 billion in debt, if you average out the cash and the debt, so they don't necessarily need to borrow, because they've already borrowed, at the best time to borrow. And here's what Morningstar says about Apple. They said it's 20% overvalued, and they're pleased with their innovations, but they're modestly overvalued. We see only single-digit growth for the company over the next few years. That's exactly what we were seeing. We were seeing like 9% growth. So it's around 3 times overvalued right now. So there's a very good chance in a really bad market with bad news, it could trade down 1/3 of where it's at now. It's trading at a higher PE than it used to. I mean, right now it's at 30 PE. The average over the last 10 years is around 16 or 17. So we might trade down to a 16 or 17 PE in a bad market. But you can see that the revenue has consistently been growing over time, and the return on equity has increased over time too. Those are all really good signs. But for Warren Buffett, he likes to buy companies with these good numbers and just buy and hold them, knowing there are going to be years, like maybe towards the end of this year and next year, where it's not going to be growing or going anywhere price-wise. So I'm learning right now that you have to choose some good companies with the good numbers and buy and hold them. This article right here says what I was saying before about how wireless carriers are intertwined in the business model with Apple. So these companies are actually giving out or selling phones to customers, like the newest iPhone 15 model, and so that allows them to hook them into their monthly recurring revenue for the cell phone service. So the problem is people aren't getting as many smartphones as they used to. They sell a really good product. I'm still using an iPhone 6, and I'm not upgrading anytime soon. But maybe if they start discontinuing the support for some of the older phones, that could be a good reason for people to have to upgrade. But Verizon, T-Mobile, AT&T, they offer free advertising for Apple's iPhones. Get your next free Apple iPhone 14 on us. But you got to subscribe to our monthly service of $200 a month. So that'll help Apple. That fight between the four major mobile companies. All right. Well, I think I've used up all my time. I hope you have a good weekend, and I'll see you all next week.